Why dumb investors win? Video by Casual Finance. I got some dumb investments. Hopefully, what I'm saying, they converge. I'll be a millionaire. I won't leave y'all though. What I'm saying? I enjoy doing this. So y'all got me forever. Believe.
Meet Dave. Dave's been trading for 2 years, which in Wall Street years is the equivalent of being a toddler who just discovered fire. His portfolio is up 13% year to date. He just hit it big on a crypto meme coin, and his confidence is at an all time high. Dave's hobbies include watching The Wolf of Wall Street, telling girls at the bar about emerging biotech companies, and zinning. It's safe to say Dave has what it takes to become a full time trader. So Dave does what any rational person would do. He calls his broker, lies about his net worth, and gets approved for options trading. Fast forward 3 months, and Dave is now leveraged to the max on out of the money Tesla calls. His strategy? Buy high, sell higher. His risk management? Prayer? His wife's concern. Why is $13,000 missing from our savings account? Fast forward three
Yeah, the
more
white
months, and the Federal Reserve decides to hike rates. Dave's portfolio is now down 67%, and his wife's new
damn.
favorite hobby is Googling how to divorce a man who calls himself a market wizard. This brings us to the question for the video today. Why do the dumbest investors win? The Dunning-Kruger effect is the financial markets version of Darwinism. It explains why dumb people think they're Warren Buffett, why smart people think they're dumb, and why Dave believes market manipulation is why his calls expired worthless. Since 2020, you could have invested in pretty much any stock and you would have made money. And if you were on the left side of the Dunning-Kruger curve, where Dave was, you would have significantly outperformed the S&P. Traditional value investors think investing is about fundamentals or fair valuations. But the investors who have outperformed over recent years buy companies at 650 times earnings, ride trends that make less sense than pineapple on pizza, and pump their bags to anyone with a pulse. In fact, I believe it was Warren Buffett that once said, "Why buy Apple when you can buy
Why that happen?
Farmcoin?" And if you
Let me
zoom
get
out
wife
even
work
further,
on.
it gets more evident. We've been in the
Mm.
greatest bull market in history, 17 years, 715% returns. The S&P's basically been on a bender since 2009. So over the past 17 years, anything you've invested in would likely have generated a positive return. And because of this, investment strategies characterized by high beta and irrational approaches have outperformed and generated alpha, although it hasn't happened yet. Like all great benders, it must come to an end eventually. But when is this end coming? And how can you prepare for it? Well, there's two ways. The first, sit on cash like Buffett has been doing. But that's boring and you're not looking to compound at the risk free rate. So that brings us to our second option. Continue to go all in and then blame others when the markets inevitably reverse. You can blame Jerome Powell, Donald Trump, or even market makers. But you gotta blame someone because taking losses on the chin isn't how investing works. All this brings us to the answer to the question of today's video. Why do the dumbest investors win? And the answer is simple. Because retail investors love volatile, high beta stocks. Let's get a little more technical real quick. What is beta and why does it matter? Beta is a measure of the volatility of a stock when compared to the market as a whole. Here's a real example of beta in play. Let's say Amazon has a beta of 1.33. This is essentially saying Amazon is 33% more volatile than the overall market. So if the markets rise
So
2%, Amazon is expected to rise 2.66%. And then if the markets fall 2%, Amazon is expected to fall 2.66%. So why does this matter? Because when the market is up, a high beta portfolio, aka a retail investor portfolio, will outperform versus the market. And now you got Dave, who's looking to book a table at Nobu to celebrate his genius. But when the market is down, a high beta portfolio is feeling the effects of gravity. And now Dave is looking to see if Payway is hiring. In a bull
ain't
market, Dave's high beta portfolio makes him the
never heard
next
that
George
before.
Soros. And in a bear market, Dave's high beta portfolio makes him the next trending post on Wall Street bets. So next time your friend brags about their 10 bagger meme coin, just remember everyone's a genius in a bull market.
Bet. Why billionaires don't invest like you? And why are they telling you the opposite? Should we just tap in with this video chat just like the last video? We just gonna make it a twin one chat, twin one, because you know this is a short video. Twin one chat. You know what I'm saying? Some
One of the striking
financial
things that I
education
heard you
ish.
say at one of my first meetings was that you could teach just about everything about investing in just a few minutes. If I were to put you in front of every single person in the country for those few minutes, what would you say to them?
Well, I'd say first, invest you must. If you don't put money away, you'll end up with nothing. Pretty clear. How to invest? Uh, don't make it any more complicated than it is. Own the stock market and own the bond market. And you can own the stock market through an all market index fund. You can own the bond market through an all bond market index fund. And that's the most sensible way to invest.
I'd probably have it all in a very low cost index fund.
Putting some money in low cost ETFs and index funds.
Invest in index funds. The fact of the matter is that this is the way to invest.
The rich love to tell you that index funds are the safe, rational, stress-free way to invest and build wealth. But crack open their actual portfolios, and you won't see any Vanguard ETF, no VOO, no VTI, not even a sad forgotten share of SPY. So if index funds are the best way to invest, why don't the most renowned investors on Wall Street actually invest in them? And the answer lies within their goals. Normal people invest to get rich. Rich people invest to not get poor. Because when you're rich, the game changes. The goal shifts from growth to, please, dear God, just don't let this fortune disappear faster than my hairline. Because if the market tanks 40%, the average Joe just grinds harder at Starbucks. But if a billionaire loses 40%, suddenly they're selling their fourth house in Aspen, and God forbid, flying commercial. And for them, that's not an option. Because if you have millions or billions in your bank account, you don't care about generating an extra 3%. You care about dodging systematic risk like it's an X at Whole Foods. And index funds?
That's
Well,
the
they are
rules
that
I'm trying to get
systematic
out there.
risk. They're the buffet of everything that could go wrong in the market, economy, and your emotional well being, served up on one convenient plate. And on top of that, billionaires are already exposed to markets and systematic risk through their own companies. So doubling down on the S&P 500 is like gambling your rent money and your grocery money on the same roulette wheel. So how do billionaires invest then? They play what I like to call weird billionaire monopoly. Hedge funds, private equity, private credit, farmland, collectibles, treasury bonds. Basically, if it sounds boring enough to make you yawn, a billionaire is already making 6% a year off it. Why are they investing like this? Well, because they're chasing uncorrelated returns. Think of it as the rich man's version of playing Pokemon with asset classes. Gotta catch 'em all. So no matter what happens in the broader market, at least one of their shiny assets is still going strong. Stocks crash? Fine, bonds are holding steady.
Bonds up,
Bonds crash? Gold is looking
bonds
strong.
up.
Gold crashes? Well, the almond farm's still pumping out overpriced milk for hipsters. This is why billionaires own farmland, art collections, and even stakes in sports teams. It's not because they just love the sport of baseball. It's because they figured out the Yankees will keep selling hot dogs if the NASDAQ implodes. For billionaires, investing isn't about creating more wealth, it's about preserving the wealth they have. So, yeah, when billionaires tells you to just buy index funds, they're right, but they're also not doing it themselves. Because when you've already won the game, you don't keep playing offense. You just run out the clock and make sure nobody steals the ball. Because concentration is for accumulation, while diversification is for preservation. And billionaires have already accumulated enough. Now they're just making sure their grandkids can still buy beachfront property on Mars when Elon finally colonizes it.
That's what we need, chat. Anyways, love this video about casual finance, man. Get rich or die trying. Believe.